Are you a new trader and want to avoid common mistakes? Welcome to a world where fortunes are made and lost in the blink of an eye. This is the world of trading, a thrilling yet challenging landscape where the wise prosper and the reckless stumble. Today, we'll be navigating this landscape, spotlighting the 5 most common pitfalls that new traders often stumble upon. These mistakes, while seemingly trivial, can spell the difference between a thriving trading career and a short-lived foray. We'll address each pitfall in detail, comparing the practices of new traders to those of experienced counterparts. We'll also share tips on how to sidestep these common missteps, equipping you with the knowledge to forge a successful path in the trading world. So buckle up for a journey filled with insights and enlightenment, a journey that could potentially transform your trading game. Stay tuned as we delve into the first common mistake. The first common mistake is trading without a plan. Imagine setting off on a journey without a map, compass, or even a clear destination. Sounds like a recipe for disaster, right? The same holds true for trading. Jumping into the trading arena without a solid plan is like embarking on a journey without any sense of direction. A trading plan is crucial because it guides your trading decisions and helps curb impulsive behavior, which can often lead to substantial losses. It's not just about deciding what and when to buy, but also determining when to sell and at what price. It's about setting clear goals and knowing what you want to achieve. Now you might be wondering, what makes a good trading plan? Well, it's not one size fits all, but there are a few key elements that every trading plan should include. Firstly, a good trading plan outlines your financial goals. Are you trading to grow your wealth over the long term, or are you seeking quick profits? Your goals will influence the types of trades you make. Secondly, it includes a risk management strategy. This involves determining how much of your portfolio you're willing to risk on each trade. A general rule of thumb is not to risk more than 1 to 2% of your portfolio on a single trade. Thirdly, a solid trading plan specifies the criteria that must be met for you to enter a trade. This could be based on technical or fundamental analysis, or a combination of both. It's crucial to stick to your criteria and not to get swayed by market noise. Lastly, a good trading plan includes an exit strategy. This means knowing when to cut your losses and when to take profits. It's all too easy to let greed or fear drive your decisions, but sticking to your exit strategy can help keep your emotions in check. Remember, a trading plan is not set in stone. It's a dynamic document that should be regularly reviewed and adjusted as necessary. The markets are always changing, and your trading plan needs to adapt to keep up. Remember, a good trading plan is a trader's roadmap to success. The second common mistake is ignoring risk management. In the world of trading, risk is an ever-present companion. Every trade, every decision brings with it a certain level of risk. And while the primary goal of trading is to make profits, it's equally crucial to understand and manage the risks involved. Risk management is not just about preventing losses. It's about making sure that the potential profit outweighs the potential loss. It's about balancing the scales, about ensuring that you're not putting all your eggs in one basket. Ignoring risk management is like walking a tightrope without a safety net. Sure, the thrill might be exhilarating, but one misstep, one unexpected market fluctuation, and it's a long way down. And the higher the risk, the harder the fall. So, how can you manage risk effectively? Firstly, it's important to diversify your portfolio. Don't just invest in a single type of asset or market. Spread your investments across different asset classes, different sectors. This can help to mitigate the risk of a single asset's performance drastically affecting your entire portfolio. Secondly, set a stop-loss order. This is an order placed with a broker to buy or sell a security when it reaches a certain price. It's a way of limiting your loss on a security's position. Thirdly, never risk more than a small percentage of your trading capital on any single trade. This percentage can vary depending on your risk tolerance. But a common guideline is to never risk more than 1 to 2% of your trading capital on any single trade. Lastly, always do your homework. Understand the market, the asset, the trends. Use technical and fundamental analysis to make informed decisions. Risk management is not about eliminating risk. That's an impossibility in trading. It's about understanding and controlling it. It's about making calculated decisions, not just taking wild gambles. Don't forget, managing risk is as important as making profits. The third common mistake is overtrading. Now, overtrading might seem like a term that's self-explanatory, but let's delve a bit deeper. Overtrading occurs when a trader is constantly buying and selling, making a barrage of trades in a short period of time. It's easy to fall into the overtrading trap. The financial market is pulsating with opportunities, and it's human nature to want to seize them all. The thrill of the game, the adrenaline rush of making trade after trade can be addictive. But here's the catch. Overtrading can lead to poor decision-making and ultimately financial losses. Think about it. With every trade you make, you're not just risking your capital, you're also investing your time and energy. And when you're making a flurry of trades, you might not be giving each one the thought and analysis it deserves. You might be acting on impulse rather than making well-informed decisions. Moreover, overtrading can inflate your transaction costs. Each trade comes with a fee, and these fees can quickly add up, eating into your profits. Not to mention, the mental and emotional toll of constantly monitoring your trades, dealing with the ups and downs, can be exhausting. So, what's the antidote to overtrading? Patience, discipline, a well-thought-out trading strategy. Don't be lured by the siren song of constant action. Take your time, analyze your options, and make your moves deliberately. Remember, trading is not about quantity, but quality. The fourth common mistake is trading based on emotions. Now, we're all human, so it's natural that emotions play a part in our decision-making process. However, when it comes to trading, letting your emotions take the wheel can be a costly mistake. Let's talk about two of the most common emotions that can influence trading decisions: fear and greed. Fear, often triggered by sudden market downturn, can lead to panic selling. This might seem like a good idea in the heat of the moment, but selling out of fear often means you're selling at a low point, potentially locking in your losses. On the other hand, there's greed. When the market is on a hot streak, it's easy to get caught up in the excitement and start making trades based on the assumption that the good times will keep rolling. But remember, what goes up must come down. Trading based on greed can lead to buying at a peak, only to see your investment plummet when the market inevitably corrects itself. When you let emotions dictate your trading decisions, you're more likely to make irrational choices that go against your trading plan or risk management strategy. This can lead to substantial losses that could have been avoided with a little bit of patience and a level head. Remember, trading should be based on analysis, not emotions. It's all about keeping a cool head, sticking to your plan, and making informed decisions based on the facts, not feelings. The fifth and final common mistake is failing to learn from past mistakes. Now, this might seem obvious, yet it's often overlooked. When it comes to trading, it is easy to become so focused on the future that we forget to reflect on the past. But reflection is a critical part of growth and improvement. Imagine for a moment that you're a scientist. Each trade you make is like a mini experiment. You have a hypothesis, you test it, and then you observe the results. What happens next? Do you simply move on to the next experiment? No. You analyze the data, you draw conclusions, and you use those conclusions to refine your hypothesis for the next experiment. This is the scientific method, and it's not just for scientists, it's for traders too. Every trade is an experiment. Every trade is a chance to learn something new. Did your trade go well? Great. Analyze why it went well. Was it just luck, or was there something in your strategy that you can replicate in the future? Did your trade go poorly? That's okay. Mistakes are not failures, they are opportunities to learn. Analyze why the trade went poorly. Was there something in your strategy that needs adjusting? Or perhaps there was an external factor that you hadn't considered. Learning from your mistakes is more than just avoiding the same pitfall in the future. It's about understanding why that pitfall was there in the first place. What led you to it? How can you avoid similar pitfalls in the future? This is how you improve your trading strategy. This is how you become a better trader. But remember, learning is not a one-time event. It's a continuous process. The market is always changing, and so must you. Stay curious, stay humble, be willing to admit when you're wrong, and be eager to learn from your mistakes. That's the beauty of trading. Every trade is a new opportunity. Every trade is a chance to learn and grow. So don't be afraid of making mistakes. Embrace them, learn from them, and most importantly, use them to become a better trader. Always remember, every trade is a learning opportunity. To wrap things up, let's quickly review the common mistakes new traders make. First, they often lack a solid trading plan. Second, they tend to ignore risk management. Third, they are prone to overtrading. Fourth, they let emotions cloud their judgment. Lastly, they fail to learn from their mistakes. The antidote to these pitfalls lies in diligent planning, disciplined risk management, trading with restraint, keeping emotions in check, and continuous learning. Remember, trading is a journey, not a destination. The more you learn, the better you'll get. Happy trading.